This is a video on passive versus active approaches to investing. There are other videos available on the Polaris Investing YouTube channel. This video is brought to you by polarisinvesting.com, a site for creating defensible valuations. As a reminder, valuation is a craft requiring skillful balance of past facts with future possibilities. Before discussing passive versus active investing, I want to stress the importance of having a disciplined and automated investment plan. Investors should target having at least 10% of every paycheck automatically invested, ideally 15%, and absolutely no less than 7%. Now, the question comes up is where to invest that money. Suggest that start off with the majority of it, up to 95% of it, goes into passive type investments, which we'll be talking about a lot more here. But that would be like an SP500 Index offered by Vanguard or BlackRock or some kind of an ETF index related fund. And then the other 5% go into active, which is individual stocks. And then as you get comfortable with individual stocks and have success, gradually increase the amount in active and reduce the amount in passive. And if get real comfortable with it, nothing wrong with taking the active up to well over 50% of your total investments. So let's talk about passive versus active. It's quite a discussion out in the marketplace as to which is an appropriate approach for an individual investor. And what we've seen here in the last couple of years is a real swing towards passive investing, which again is investing in something like the SP 500 Index, and has resulted in a fairly small, relatively much smaller amount being done in active. Now, passive investing still only represents, in the neighborhood of 30% of all money that's being invested, but it's the incredible increase that's been occurring that some even project within the next 5 years or so, passive investing could even overtake active investing for the entire market, which is saying quite a bit. So what are some of the trade-offs with passive versus active? Well, passive investing is really a type of momentum investing, which is really trend following, because they're purely price takers, not doing fundamental analysis and then waiting for individual stocks of the index to reach a certain price before buying or selling. Passive investors, by very nature, are buying the whole haystack. You could say the active investors are looking for the needle in the haystack. Now, if you're using the S&P 500 Index, you're obviously just buying 500 stocks out of the 6,500 stocks that trade in the U.S. and over 42,000 stocks that trade globally. But the S&P 500 represents almost 70% of the total U.S. market. And the U.S. market makes up around 40% of the global stock market in terms of market cap. So the S&P 500 Index is not the whole stock market haystack, but it is a significant portion. Now, just an interesting side note is around 40% of U.S. corporation revenue is from outside the U.S. So the S&P 500 Index does provide global exposure indirectly. Another interesting note is that stocks as an asset class make up just 25% of global financial instruments, which are mainly government, corporate, and consumer debt. So it's important not to lose perspective on stock investing. It should be considered a portion of your overall investment strategy. The fees associated with passive investing tend to be extremely low. Vanguard, for instance, has dropped their fees to well below 0.5%. per year for investing in their funds. Now let's talk a little more about the S&P 500 index itself, because it's the most prominent type of index fund that people invest in. The average return for the S&P 500 is right around 10% per year, but you can see here dating back to the 70s that the specific returns year to year range quite a bit, and that the overall average is really rarely occurs in a given year. It's usually well below that or well above that, and then let's stress the average is 10%. And down here at the bottom is a chart that shows just how much volatility occurs year to year, and then the major news events of the day that were likely behind those kind of movements. Over here to the right is showing other periods of times volatility. You can see here that 1% or less 70% of the time, and then 2% or less 95% of the time on a daily basis. But when you look at monthly, yearly, you see a lot bigger changes in performance from one of those periods to the next. The overall distribution of returns of the S&P 500 are fairly normal, but have extreme fat tails on both the upside and the downside, and there can be sudden sharp movements to either side. Also, the index, like the overall market, can go into long-term, or what they refer to as secular movements. You can see here back in the bottom left-hand corner here of this graph is that through here is kind of a secular, over decades, a secular increase. Trend is an increase, and then you can go into a secular decline. So it's important to understand both short-term and extremely long-term trends in the market. Another thing to keep in mind regarding volatility is that with most stocks, 90% of the time, they trade at more than 5% below their previous all-time high. Now, this graph shows this phenomenon with the Dow Jones Industrial Average, but the same phenomenon pretty much applies to the S&P 500 Index and even down to individual stocks. As mentioned earlier, stocks in the S&P 500 represent around 70% of total U.S. market cap, but in terms of number of stocks, only represent less than 8% of stocks trading in the U.S. Now, for comparison, the smallest 60% of stocks traded in the U.S. have a combined market capitalization of less than 3%. What's interesting is the stocks that make up the S&P 500 only stay in the 500 index for an average of 15 years. That means on average, over 30 stocks get replaced each year in the S&P 500. The S&P 500 index does have minimum requirements for a stock to be included in the index. Must have at least a $6 billion market cap, so you are talking about larger companies, and the daily trading volume must be at least 250,000 trades a day. So if you're investing in an index, the S&P 500 index, you are investing in a small percent as far as numbers are concerned of the overall market, but it is a rather large percent of the overall market cap. Let's talk about active investing. Active fund managers typically try to beat the index by at least 6% annually to justify their fees, which can be quite substantial, anywhere from 1 to up to 2% of assets under management, and hedge funds typically charge an additional 20% of net gains. So very high fees compared to the passive index. 6% is just a target. Some active investors do much better than that. And here's an example. All heard of Warren Buffett, but not many realize that from the time he turned 60 to when he turned 80, now he's currently 88, but these 20 years in particular were very productive years for him, where he increased his net worth from $2 billion to $70 billion which was a 20% annual increase year over year. So if you think of the market, S&P 500 makes about 10% on average. Active investors try to take it up to 16%. And then you see someone like Warren Buffett, who's been able to do around 20% on average. In those 20 years, Warren has increased his net worth 35-fold. But Warren has not been immune to extreme short-term market movements. His fund, Berkshire Hathaway, has lost 50% of its value 4 times during the life of the fund. Now, the reality is that most active funds, shows here 65% of them, underperform their target index, which is typically the S&P 500. Those few fund managers that are able to outperform the S&P 500 index don't maintain that performance for long. In fact, a recent statistic was published that said that fund managers that are currently in the top quarter of all, in terms of performance of all fund managers, that less than 10% of them are still in the top quarter performance 3 years later, and 5 years later, less than 2% of those same managers are still in the top quartile performance. So it's a very difficult thing to do year over year. Another thing about active fund managers is they have to be concerned about short-term performance, because fickle investors will leave the fund if they have significant short-term underperformance. So they often get more concerned about their careers than they do about their investors. And so what they tend to do over time is end up creating kind of become closet indexers. Is that since they're measured against the index, they don't want to they want to do better than the index, but they don't want to do drastically lower than the index. So they just become more and more like the index that they're being compared to. Now, individual investors have big advantage over a active fund manager in that individual investors can truly think long term. It's hard to do because in the short term, as we've been talking about throughout these videos, that in the short term things can go against you, and you can look wrong for a long period of time. But as an individual investor, if you're well aware of that phenomena, can stay the course and more likely realize the long-term returns. Well, the difference between passive investing and active investing can be substantial, providing that investors stay long-term, where there's more certain outcomes. And like Warren Buffett has demonstrated with his average annual performance, if you can average well above a 10% return over 30 years, it makes a significant difference. For instance, a 16% average return results in a 5-fold difference in outcome. Of course, this requires enduring a lot of extreme ups and downs in the market and a willingness to look wrong for long periods of time. Now, it's far from guaranteed that you can get a 5-fold increase, or everybody would be doing it. But the key is that you've got to think long term, because that's where the more certain returns are, and you've got to be smart about exactly what you invest in terms of being active. Well, over here to the left is a range of different types of ways you can do investing, ranging all the way here to the right, which is true active, and obviously it's the high commission fees associated with being true active. And then the other extreme is being true passive, which is like with the S&P 500, that's pure market cap weighted type index. Well, what most people don't realize is in between there's different approaches. Moving from right to left, you could just go with more diversification than, let's say, one stock, and obviously that's what is recommended by most people. And Polaris says that too, that you should have at least 10 to 15 stocks at any given time and be diversified if you're going to be an active investor. And then let's go from left to right. You can also do a thing called factor-oriented, which is implemented primarily through electronic traded funds, or ETFs. There are over 2,200 ETFs representing around 6% of the total U.S. equity market. ETFs group stocks ranging from broad indexes to specific factors like momentum and size. ETFs are predicated on asset allocation being more important than individual stock selection. What I want to focus in on now is this middle approach, which is just called alternative weighted, which means you don't necessarily use a factor approach. You don't do the S&P 500. You don't do an individual stock, but you do a form of diversification that's specific to the S&P 500. But instead of the whole haystack, like is typically done with passive investing, you intelligently select a subset, 10 to 15 stocks out of the S&P 500, and hold those. For details on how to build an S&P 500 beating portfolio, you're invited to watch a video blog that's been posted out there on that topic. Well, this has been a video on active versus passive investing, and landing on the ideal approach would be to use a subset of your overall investments on creating what's been called an alternate weighted portfolio, and then even referenced other videos you can watch on the details of building or creating that portfolio. Anyway, thanks for watching.